Hi everyone, Mr. H here. This is part 1 of chapter 3.7, Cash Flow. In this part of the presentation, we will explain the concept of cash flow and its relationship with profit and working capital. So let's get started. Every business needs cash for their everyday activities. They get cash from their sales, they get cash from other sources, and then you use that cash to pay for the regular everyday expenses or monthly expenses. So, making sure that you are solvent as a business, making sure that the business has liquidity to pay for their day to day activities is an important goal as a business. So, cash flow is the flow of money in and out of a business over a time period. Okay, so it's how much money is getting into the business from different sources. I mean, especially from sales, but it can be from other sources, and how much money leaves the business, how much money we are spending to pay for our day-to-day activities. So that difference, cash inflows minus cash outflows, is what we call the net cash flow of a specific time period, usually a month. Okay, and we can actually take that calculation from a number of months to see how the cash flow goes, how money flows from month to month in my business. Um, so the cash flow will allow me to evaluate the solvency of the business, the ability of the business to meet day-to-day activities. This number, this value, doesn't have to be confused with profit. So cash flow is not profit. Uh, you have to consider that when we're talking about profit, we talk about sales revenue, and sales revenue considers both cash and credit sales. So when we get the profit from the profit and loss account, for example, we're considering all sales, all revenue, and then we are getting the profit or loss from the different costs. Cash flow is different. We are talking about just cash revenue, other cash inflows, and the cash outflows or cash expenses of a month. So this is evaluating to what extent the business can actually pay for their day-to-day activities with that cash coming in and out of the business. Not necessarily it doesn't necessarily compare to profit, loss, and revenue, which is a different way to look at a business. This is not about profitability. This is about solvency or liquidity of the business. So, based on this consideration, we use cash flow and profit to understand what's going on with our business in terms of profitability and solvency. For example, the business can be profitable, okay, good, they have a good level of sales, they are keeping their costs low, so they have some good level of profit, but it can be insolvent even though profitable. Why or how? For example, the business can have bad credit, which means they are selling too much on credit, so they have too many debtors. Therefore, even though on paper, on the profit and loss account, even though there are a great number of sales, if most of those sales are by credit, this means they might end up becoming insolvent in the short term. Why? Not having cash to function would be a problem if debtors are not paying, or there are too many debtors not paying. Lending cash, using cash money to lend to a manager, a member of the personnel, to another business. Using the cash money to lend money to others would be also a problem. It might end up making the business insolvent. Okay, even though profitable, even though sales are amazing. Um, Too many fixed assets purchased at the same time would also be a problem. Using that cash, investing that cash to buy a lot of assets at one moment would end up, again, leaving the business without any cash to keep functioning in the following months. So you have to have that clear, not to buy too many assets at the same time, especially the fixed long-term assets. Buying too much stock, over trading, okay, buying too much stock with cash when you are not actually going to use that stock for production or sales. That overtrading would also lead to using too much of your cash at a specific moment and leaving you without enough cash to keep running. So this happens when you are profitable but still insolvent. There's not enough cash to keep on running even though you are having sales and being profitable. The opposite is also possible. You can actually be solvent, have cash to keep the business running, but be unprofitable, not having poor sales and not getting enough, or having too high costs and not getting profit, getting losses. Why would this happen? Number one, high gearing. If you are relying too much on bank loans, sorry, if you are relying too much on bank loans, if you have a high gearing ratio, this means that you would have to pay a lot. You have to use a lot of your sales to pay for the loans. This would actually end up making you unprofitable, even though there's cash from the money you just got from the bank. Also, you can get cash from the sales of assets, but this doesn't mean you are being profitable because you are not getting cash from sales, just from the sales of all assets or unused assets. So that doesn't mean you are being necessarily profitable. It is making you solvent, not profitable. Getting cash from shareholders providing cash to keep the business running. This again would make the business solvent, but it wouldn't really make it profitable unless you actually sell and get some revenue and then keep some profit for yourself. So you can be solvent but unprofitable. You can be profitable but insolvent. Talking about this conversation leads us to the idea of working capital. Working capital is specifically that, the money you need to keep the business running. We already discussed or presented this concept when we talked about the balance sheet. We said that the working capital is also known as the net current assets, which is what we get when we subtract the current liabilities from the current assets. Okay, and we get the liquidity. Remember, we also discussed about liquidity ratio in a previous video. So working capital is what we use for our everyday activities and what ends up becoming part of the cash and then the cash flow. There is a working capital cycle in every business. Okay, so there is a process from the moment money comes in, we use that money, and then we sell, and then we recover that money that we invested. Working capital might look like this. We start by purchasing raw materials with the money usually from cash. Okay, it might be from other sources, but usually from cash. Then we produce our goods, we provide the service, then we sell the products and or the goods sold are sold. If they are sold on credit, and this is a situation, we might have to wait until we get the cash back from our debtors, and then when we have the cash back, we finally can again purchase raw materials, and so the cycle goes on and on. The problem would happen if we are selling too much on credit, or if our debtors are taking too long to pay back for those goods, for those products, then the working capital will take longer for us to recover cash, and this would end up affecting our cash flow. The idea, the goal, is that we try to keep our cash moving in and out in the shortest periods possible. So the idea would actually lead us to not, for example, selling too much goods on credit, or trying to keep a safe, healthy relationship with our clients so they can pay back as soon as possible. Thus, we would make it possible for us to keep the working capital cycle running smoothly and keeping our cash flow positive every month, leading us to work properly and obviously contributing to getting profit in the long run. So this is the very first part I wanted to share with you in this video. In the following video, we are presenting the cash flow forecast and also the benefits, the limitation of the cash flow forecast, and how we can actually improve our cash flow, either by increasing the inflows or reducing our outflows. So this is it. See you in the next video.